Hey everybody, it's Jonathan. How you guys doing? All right, can everybody hear me okay? Just got a little feedback in the chat. First time presenting on here, guys, so if it's not as smooth, my apologies, but just trying to figure out this system. So can I get a little sound check out there? All right, fantastic. Thank you. Thanks, fellas. All right, guys, let's get going. So I'm going to just start with a basic risk disclaimer to get us going, and then we will get into the fun stuff. So trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. So as we know, these are educational presentations. Whenever I talk about kind of specific levels, it's just where I see value in the market. It's obviously not a trade recommendation to any one person. All right, so let's get right into it. So here's the big promise that I have for you today. What you're about to learn from me in this next hour, this works. Okay, I've taught over 100 traders this exact trade, and that's 100 professional traders. I'm also going to speak definitively about this trade because it's special and that's important to understand. But I'm also probably the only one in the world that's teaching this approach to bond futures, okay? So this is going to be for any trader, anyone who's risking money in the market to achieve whatever individual goals you want. It's simple, it's straightforward, but most importantly, it's correct. And it's not taught in other webinars, and you're not going to learn about it in trading books. Now, I've broken this process down. It's the exact way I trade bond futures, and it's actually transferable to other areas of the market as well. So you can use it for ETFs or stocks or ETF options, but it's the foundation to value fixed income forever. So I'm not asking you to believe anything just yet, but I am asking you to keep an open mind, because maybe even put your common sense hat on. Because regardless of what everyone promises, if you go to the Chicago Mercantile Exchange website, this is exactly how you're supposed to trade bond futures. If you're just trading ZB, betting whether it goes up or down, just trading TLT, hopefully by the end you'll see what a significant disadvantage you're at to those who are properly trading fixed income. So here's what I'll show you today. I'll show you it's a proven approach to trade bonds with a high probability of success without crossing your fingers and hoping for the market to move in your direction. Okay? This trade's about consistency. It's so consistent that one of my new bond students is 6 for 6 in his first trades. And his account's gone from 8 grand to 12 grand in about 2 months. Now, it's not going to be like that for everyone, but the key here is this trade makes sense. And throughout the presentation, I'm going to show you lots of proof as well. I'm going to show you proof in my background. I'm going to show you proof in my client success, just to show you that this trade really works. So before I get into all that, I want to share a little bit of my background so you know with absolute certainty that I'm only speaking from direct experience. My name is Jonathan Rose. I've been trading for 19 years. That's all I've ever done. Some of the things I've done throughout my career: I was the director of a trading fixed income proprietary trading shop for 8 years. At that shop, I've trained over 100 professional traders. I've consulted with 2 major hedge funds about this very trade. And I've done quite well just trading bonds. Over 10 million in career earnings just in this specific trade. So I only go through this not to boast. I go through this for your comfort. I just want to share my experience so you know I'm the real deal. My specialties are going to be in bond futures and options. Now this trade here is special because it's just black and white, which means you'll know if a trade's good or if a trade's not good. There's no feel. I personally think feel is a bad word in trading because it's not real. So not only do I talk the talk, I absolutely walk the walk. So congrats, guys. Bond trading is a hidden gem in the trading world. I didn't realize this, but after talking with my clients, I didn't realize how little or how retail traders haven't seen the accessibility of these markets. Bonds are my consistent go-to trade, especially right now. So today, I'm not going to show you a trick or something you can use once. I'm going to show you how to trade an entire sector of the markets. Okay? Let me stop here and ask, for those who are on here watching it live, who here trades bonds? Or maybe, if you could just throw in if you trade ZB or TLT, or if you're open to looking at the rest of the futures on the yield curve. Okay. So Jay never looked at bonds. Are you trading futures? Nice. Cool. Well, I've seen a few others teach bond trading on the internet. Okay, some options on TLT. Not at all, no. Okay, cool. You guys will like it. It's a really cool trade, really interesting trade. And Matt, if you're trading options on TLT, you'll get a ton out of this just by seeing, how we can value different points of the yield curve. So here's how it's going to work. At the end, I'm going to go through and I'll show you how to get more. And more will be an accelerated process with advanced training. More will be everything you need to take this training to the next level. For some of you, it'll make absolute sense, and that's great. I look forward to working with you. On the other hand, if advanced training is not for you, I completely understand. That's totally cool. I appreciate you guys coming and hanging out with me. Go over the possibility of this trade. I want to share a client, Dave. He's had since the beginning of January, in just 2 short months, phenomenal success with this trade. When he sent me this email, he was up 51% in his first 2.5 weeks. And now he's up 90% just by trading bond flies. Okay? So if this seems overwhelming at first or confusing, you're in the exact same boat every one of my students were before they started trading bonds. But over time, if you're willing to do the work, the trade makes sense, and I can teach it to anyone who's committed to learning. Okay? For those of you who are here to really learn something, maybe who are frustrated with some of the other content that's taught online, imagine if you learned a specific trade. A trade that gave you a go-to place that you could always just find consistency, that you really fell in love with. Imagine if that trade was so interesting to you that you put everything else that you're learning on the back burner. Okay, picture that. Because if that was really the case, wouldn't that inject a newfound energy into your trading? Maybe it got you closer to whatever goals you're going after. Okay, because so many trade without a real understanding of why. That's what I always want you to ask yourself when you're in a trade. Why are you doing that? What's the reason? Why are you risking the money that you sacrifice so much to earn? So I want to share how I got into this trade. So I moved to Chicago the day I graduated from school, okay, in '97. And I started in the business trading Nasdaq futures. I clerked at first, which means I got a lot of coffee and wasn't treated nicely for 6 months. But then what I did is I pitched my uncle on an investment deal. I told him I could trade. I knew I could. I was always quick with numbers. I was competitive, athletic, disciplined. It was in my DNA. After a few days of meeting, I got funded with 80 grand and I was off and running. And it didn't take long before I had results. In fact, right out of school, after my first year trading, I was able to make over $1 million. Paid my uncle back $360K after 6 months, on top of the $80,000 he lent me, and I was now self-funded and off and running. I thought I was the man. I thought I was just destined to do this. But in fact, I had no idea what I was doing. The only thing that I did have was I was in the right place at the right time. So here's when I traded Nasdaq. The green rectangle shows the time period. The trade was amazing. It was volatile and traders had real edge. Okay? It was actually easy. But when the Nasdaq hit its low in 2003 down here, the trade really dried up. It was absolutely terrible. For 6 months, I couldn't make a dime. Okay? My confidence was wrecked and I considered walking away from the business. But here's the lesson that I learned. In good trades, anyone can make money. The best are going to kill it, and even new traders can do very well. In bad trades, the best are lucky if they break even, and the worst are going out of business. Okay? When the Nasdaq bottomed here, I couldn't make a dime. I considered quitting, locking the money I made, going back to school, moving back home, starting a business. But it was just because I was in the wrong products. And eventually, I moved over to start trading bonds. Some of the other guys from the Nasdaq pit were moving over to trade bonds. I joined them, and I started in June of 2003 when the Fed started moving. The first month of trading bonds, once the Fed started moving, I did phenomenal. It was back to being in a good trade. I was the 6th employee of this firm. We grew it up to 200 people before we eventually sold out to a major hedge fund. At that time, I was trading so many fixed income contracts that the Merc was flying me all over the place to all their best events. Playing with Natalie Golbis on the left and playing with Tiki Barber over at Baltusrol Country Club. Okay? Getting myself in a lot of trouble for a young fellow. But just when the Fed stopped moving in 2008, 2009, this trade dried up. This trade became terrible. And this time I wasn't getting stuck. This time I left. Options were having exponential growth, 2009, 2010, and went to go be a market maker on the floor of the Chicago Board Option Exchange. Now the major takeaway and why I go through all this is good markets are 10 times easier to trade than bad markets. That's it. In good markets, there's more fat to trim, which makes them more predictable. Okay, I went through all that just so you know I'm not another guru just talking about nonsense. I went through all that because I see my clients are frustrated with all the information that's online. I see people just overwhelmed. And my mission is to change that. I just want to add clarity for you and I want to simplify trading. Right now, the Fed's moving. Bonds are a great trade. Futures are a great trade. Options are tough. The VIX is trading 11. When the VIX trades 11, options are tough. So you have to go find what's moving, what's in play. Right now, the bonds are in play. In play gives us movement. Movement gives us volatility. And volatility is where the opportunity is. You need movement to be able to make some money. Great. You can sell options and you don't need movement. But if the VIX is at 11 and you're selling options, there's no premium, right? You're risking $5 to make $1. That's not fun. We don't want to do that for too long. So let's get into bonds. The 3 secrets to trading bonds. Bonds are a puzzle. Once you learn how to put that puzzle together, they'll make a lot more sense. 2, being in the right bond is key. Okay? You don't want to just trade ZB, the 30-year, the TLT, the 30-year. That's going to be the same as the ZB in ETF form. You want to go where the value is. And 3, once learned, this is probably one of the most consistent trades you'll ever see. Interest rates and bonds. Probably know this. When interest rates go higher, bond prices go lower, right? When rates go lower, bond prices go higher. Why that happens? It's not so important, but I'll go through an example. Why that happens is if I buy a 30-year bond and I do that and I put, $1,000 in a 30-year bond and I get 3% a year for 30 years. Whoopee, great return. All of a sudden, if the 30-year rate shoots up to 10%, just in a phony baloney example, I'm still holding a bond where I'm only getting 3%. So how am I going to possibly sell that bond? How am I ever going to get rid of that bond? Well, the only way I can sell that bond is as rates go higher, the price, my face value, the price that I paid is going lower. So the only way I can get rid of that $1,000 bond is maybe I'll sell it for $200. The person who buys it, they can have my 3%, but that bond also matures at $1,000. And that's the difference. That's why when interest rates go higher, prices go lower. Okay, that's the push and pull. Let's get into the bond puzzle. And this is going to be key. And for bonds, I'm going to use a silly example that I don't know anything about, but I think this example helps. Let's use diamonds. And I'll also qualify this by saying I don't know a thing about diamonds, besides the one I gave to my wife, which cost me too much money. So let's say all of us on this presentation are going to a flea market together. It's a one-day flea market. And they only trade diamonds at this flea market. And these are the prices. The 1 carats are trading for $1,000. The 2 carats are $2,000. The 3 carats are $3,000. The 4 carats are $4,000. We all go to this flea market. There's a ton of transactions going on. Okay, and this is all they're trading. After 5 hours or so, prices change. And here's what happens to the prices. The little stuff, 1 carats, they're still trading for $1,000. Okay, there's not much demand there. 2 carats are going up a little bit. Those are trading for $3,000. The 3 carats are trading for $4,000. But the 4 carats have doubled in price because there's a ton of demand for that really big stuff. Now, maybe if we walked into this flea market with some diamonds, we might decide, hey, maybe we should sell our 4 carats because we just doubled our money. And let's invest in those 1 carats because, hey, maybe the 1 carats are going to catch up. What happens if the 2 carats start trading higher than the 3 carats? That might happen just based upon supply and demand. But over a long enough time period, it's probably going to, let's probably give it the benefit of the doubt that 3 carats are going to be more expensive than 2 carats, right? This is how we have to look at fixed income. We have to look at the relative value of all the instruments. Because if you don't know what's going on with the 2 carat and the 4 carat, you can't value the 3 carat. You're flying blind. So just like this example in diamonds, we do it in yield curve. And the yield curve is going to be the futures contracts that are traded. We have the 2-year, which is the ZT, the 5-year, which is the ZF, ZN is 10-year, ZB is 30-year, and the UB is ultra. All this stuff like 1 month, 3 months, 6 months, this is all euro dollars. This is not what we're talking about. This is what we're talking about, and these are very, very liquid futures. For those who've never traded them, they're like trading the S&Ps. That's how liquid they are. A big mistake that a lot of people make when they're trading bonds is they assume the ZB is a 30-year. The ZN is a 10-year. It's not the case. When you're trading the ZB, you're not trading 30 years. You're trading 18 years. The ZN is going to be closer to 7 years. The ZF is going to be closer to 4 years. Now, what I like to do, and how I think these should be traded, is we don't want to guess whether rates are going up or down. Okay, let's leave Goldman Sachs to do that kind of stuff. That's gambling. Okay, that's not really sustainable for the long term. At least it's not scalable, that's for sure. You can do it for a little bit. You can make some money here and there, but I really don't know many full-time professional traders that are betting in a binary outcome of something just going up or down. Okay? What we do is we trade the relationships. And think of the ZT and the ZF together as like a rubber band. The 2 and 3 diamonds, carat diamonds. Sure, they may be off value. They may move independently based upon supply and demand. But inevitably, just like a rubber band, they'll pull, but they're going to come back to some semblance of value. Okay, these are all just futures, right? They're just open to be traded, supply and demand driven. So what happens is, let's say a hedge fund blows out. They go out of business. They're short an enormous amount of 5-year future contracts. When they go out of business, they have to buy all those 5-year future contracts back. So maybe the ZF, or I flip the example around, maybe they have to sell a whole bunch of 5-year future contracts. Maybe China comes in and needs to sell a whole bunch of 5-year future contracts. 5-year future contracts are going to get inexpensive, but they're not inexpensive like they're just inexpensive, like they're too low. They're inexpensive relative to the 10-year. They're inexpensive relative to the 2-year. They're inexpensive relative to the yield curve. So what traders do, and what the real role of a trader is to keep the market in line, is to allow the market to be efficient. As people who trade these, who stare at these, when we see something like this, we can buy ZF and at the same time simultaneously sell ZN. I colored it like this because we can do a butterfly. And a butterfly is a belly, which would be the ZF, and the 2 wings would be the outside. So you buy one and sell the 2 others. Option traders, you guys are familiar with butterflies and iron condors. Same thing. We can do the same thing if we look at the ZN. The ZN we're going to look at next to the ZF and the ZB. It's a relationship. This trade right here, ZF against ZN, the only difference between these 2 contracts, guys, are a 4-year bond and a 7-year bond. How far apart are they going to get? Probably, if they do get really, really far, they're probably off value, right? They're driven by supply and demand. At times, the market is going to be somewhat inefficient. As traders, we look for opportunities, to bring that efficiency back. Same thing. 10-year gets expensive. We can sell it next to its neighbors. The time frame for trades like this could be anywhere from an hour out to 2 or 3 weeks. Okay, these are definitely more swing trades. We can trade these during the day. I'll show you how to do that as well. But these specific type of trades, these are going to be more swing trades. Okay, same thing. We go out further in the curve. UB gets inexpensive. Maybe ZN gets expensive. There's a trade that you clearly want to do. If you're looking to sell bonds right here, you do not sell the ZB. You do not sell the UB. You want to sell the ZN. If you're bullish on the bond futures, you do not want to buy ZN. You want to go where the value is. And in this example, you'd want to buy the UB. So here's an example of the 5-year future contract against the 10-year future contract. Okay, it's just this little piece of the curve that we're talking about. That's it. And we're trading the relative relationship. So as it moves around, when it gets down here, the 5-year is inexpensive relative to the 10-year. Okay? It always baffles me. It's like in every single thing that we do, we value things relative to one another. You buy a phone. You buy that phone because against another phone, it's got cool features and it's a good value, right? We're not just blindly buying any phone. You buy a house, you buy an apartment, you're buying it relative to other things that you've seen. But yet, retail trading community, when it trades stocks and futures, they do everything in isolation. And it's just odd to me. Everything needs to be valued relative to something else. There's no such thing as something being cheaper or expensive, oversold or overbought. Those are just buzzwords, right? Common sense would tell us that if the relationship between these two break down, let's look for opportunity to take advantage of that little inefficiency. That's all we're doing. Common sense, take a step back. This is the 10-year against the bond. These are mean reverting trades, guys. So if it gets too far out of line, making trades just to whack them back into line, keeping things nice and simple. What this here? This is the 10-year butterfly. This is going to be the 10-year as the belly against the 5-year and against the 30-year. So as the 10-year butterfly gets expensive, that's just saying the 10-year is expensive relative to the ZB, relative to the 5-year. So I was going to hop into that. Why do we add? So what I'm doing here is these are all DV01s. And what I'm doing is I'm making them have the same value. Okay, in order to trade these, that's part of the process. You need to learn that. So just like here, I've done this with the butterfly. If I go up, the relationship between 10-year and bonds are a 3-to-1 relationship. That's how we normalize them. That's how we chart them. That's exactly how you trade them. We'll get into that a little bit more at the end. So what I'm doing right here, this is the yield curve. This is 2-year out to 30-year. Yeah, Ravi, that's all taught in the bond bootcamp, which we'll get into. So what this is here, guys, this is 2-year against 30-year. This is following the yield curve. Okay, you may have heard on CNBC, the yield curve's flattening, the yield curve's steepening, right? Over time, this goes back to 2014. This is how we can look at the relationship between 2s and 30s. The yield curve flattened, flattened, flattened. All this means when it's flattening is the difference between 2-year and 30-year rates were getting smaller and smaller and smaller. So if we take you back to 2014, the 2-year might have been, 0, and the 30-year might have been 4. But bring it back here, the 2-year might be 1% and the 30-year might be 3%. So that relationship is getting closer and closer together. It's flattening. When the yield curve finally bottomed out in July before the Fed started moving, here's just the S&P chart. At the same time it bottomed out, that's when the S&Ps broke out. And you can start seeing relationships behind these. These are major structural changes in the overall market. So not only can you use the bonds to find those little trades, you can also use them to trade outright, which I'll show you as well. But one of the indicators that I always use to monitor the overall economy is 2s bonds, the value of the overall yield curve. You can see nothing going on, flattening, flattening, flattening. There was obviously a big move here, which coincided with this here. Okay, so they're all kind of moving together. When the big structural change came in 2s, 30s, it's not surprising that, okay, that's when the equity started moving as well. Okay, it's just adding another component to your trading. Okay, every little piece you get more and more edge. So this is kind of cool. Not that. So if I just take you here, guys, if I take you to CME, ICS. So let me take you here. And so this is directly from the CME group. Okay. Down here, Treasury spread ratios. There you go. That's what we're teaching. This is the correct way to trade these instruments. The Merc provides all this information. We also teach you how to derive this information yourself, so we're not dependent on the mercantile exchange, but they're telling us the correct way to trade them. This is exactly how professionals trade bond futures. Okay? Really, really cool trade. So I just wanted to show you that to show that this is not something that we're just making up here. Okay? Oh, man. Okay. So trading really comes down to being confident in an approach, really believing in an approach. Because when you're down money, you need to make an important decision, right? And the decisions that you make depend on the trust you have in your approach. Because what I found in working with clients is that many splinter themselves. They learn a little bit about everything, but not very much about anything. Okay, I have clients that go on 20, 30 webinars, learning a little bit about this, bouncing around to GAN, Fibonacci, clouds, all these different tools. And I find it does more harm than it does good. So what I always like to do is just simplify. And I try to show that by just the ideal path, but using common sense. Here's an example of another client. Reached out to me, paid $5,500 for one subscription. And then he had to upgrade for $2,500 more. Okay, just absolute nonsense. Bouncing around, learning the clouds, the momentums, the fibs, all the nonsense. It's just a new perspective because people haven't seen this trade. But anybody, if you're trading ZB or ZN, this is the proper way to do that trade. Mike's been with me now for 5 months. And he's the one I said earlier where his account went from 8 to 12K just doing this trade. I'm always available to help him. These are all the emails that he sends me in a short amount of time. So here's how my style is different, guys. I've taught this trade to 100 professional traders. I make my living taking money out of the market, which forces me to stay on the cutting edge. I really believe the information that I'm sharing with you right here is in a different league than other educational competitors. Okay? It's tried and it's true. And for those really looking to make trading work, it'll open your eyes to a brand new approach. Trading's not brain surgery. Okay? It's just learning the right thing from the right people and then learning how to play the game and building up confidence. How often do you guys really see a fresh trade? A trade that comes across that you've never seen before? Probably not too often, right? The benefits to learning this are endless. So now, guys, if you're interested, I'll go over exactly how the Bond Bootcamp program works. It's a special opportunity to learn a very cool trade. It does take some work, but if you're committed to learning, it's a trade that you'll really get a ton of benefit from. So I'll go over exactly how it works. So Bond Bootcamp, it's the foundational course. It covers everything you need to understand this trade. You might end up watching it a few times. You'll ask questions. You can email me directly, Jonathan at Active Day Trader, with any of your questions. And over time, you'll get it. You'll get more and more and more until you finally say, wow, I get it. For those, when you learned options, it's very similar to that. Okay? Here are the benefits that you'll get. For one, it's a proven approach. It's a real trade. Okay? It's not some gimmicky trading trick. Of course, with more knowledge, you're putting yourself in position for potentially better results. It's super straightforward. Right now, I'm sure it's somewhat overwhelming, but like others before you, we'll learn this one step at a time. Diversification. It's not correlated to anything that you're doing right now. And then finally, it does give you the foundation to trade bonds forever. For those who've never traded futures or never traded bonds, that won't matter. If you're committed to figuring out a way to make money in the markets, this is for you. If you're not willing to give 2 hours or 3 hours to do the work, this is not going to be for you. Okay? This is definitely not a magical potion. There are lots of those being sold online. Here's another client, Steven. Steven came to me as an options trader, young stay-at-home dad, looking to make extra income while home with his 2.5-year-old. He learned to trade options from some random site and he was ready to give up. After talking with him and listening to his story, I suggested the bond trade. Steven's now doing great. He tells me he only wants to trade bonds now. And you can see from the feedback, he's a stud. So here's how the program works. I've personally never done any workshop that's been longer than 2 hours. I don't filibuster, there's no BS. Okay? So you learn what should you trade. I go over the different personalities between the 2-year, the 5-year, the 10-year, the 30-year, and the ultra. Because they do have different personalities. The further you go out on the yield curve, the more volatility you're going to find. So for those who are like me, who don't have a lot of patience in the trade, I hate sitting around with 2-year. It's just too slow for me. I like to go on the back end of the curve. It's something faster. It's more exciting. I simplify the yield curve. I actually break it up into kind of like 3 levels. So level 1 is going to be outright trading. We use those butterflies to value the yield curve to see which outright product we should be in. Level 2 is going to be spreads, 5-year and 10-year, 10-year and 30-year spreads like that. And then level 3 gets into some advanced stuff. The workshop also covers a little bit of stocks and options in ETFs. So here's what you get. Bond Trading Bootcamp for futures and for stocks and options. And I also include easy to read bond specs. Easily worth over $5,000 for all this information, and you can't learn it anywhere else. Bond Trading Bootcamp's a 3-hour on-demand class that's yours to watch immediately. Bad timing? What if you have too much on your plate right now? Is that plate of education producing results? Because if it's not, if you're trading something that's not working, that you think it's going to start working, I would stop. What happens if what you're doing, instead of starts working, it gets worse? What happens then? There's no bad timing. When you see something special, you grab it, you devour it, and you decide it's time for a real change. So also, you get something called Fed Dominator, which used to be a secondary product, but now I brought the 2 of them together. Fed Dominator shows you all about butterflies, exactly how to construct the butterflies, and this one's focused on outright trading. So you always make sure you're in the right contract. So this is a separate workshop. Bond Bootcamp's 3 hours, Fed Dominator's another 1.5 hours. Share my exact capital account of when I finished trading bonds. December 08, $40,000 months, $270,000 month, $100,000 month, $200,000 month. This is a legit trade that really works. So in addition to the on-demand workshop, you get that Fed Dominator. There's a cool hedge fund tool in there as well, which is a PDF, which I go over the last 2 times the Fed moved, when the Fed raised rates and lowered rates between 03 and 08. And what that PDF does, it's 20 pages. It tells you the exact level the bonds were trading at every point that the Fed moved. Okay, this thing took me 20 hours to build. Just that PDF alone. Here's Stacey. Stacey had been struggling doing the same old thing. He felt like trading was about luck. So frustrated, he started working with me in October of last year. I remember Stacey wrote me a long letter saying he's willing to put in the effort. He just hasn't found the right thing to trade. I called Stacey and said, I got you. Stacey took my bond bootcamp, and his first trade, he made enough to cover the entire workshop. And now he's trading more bonds than anything else. So before I get into the price, listen, it's not $5,000 or $3,000 or something crazy like that. But let me ask you a few questions. If all this investment did was show you the correct way to trade bonds, would it make sense? What about if all it did was show you what a really good trade looks like? Or if it just protected you from any other bond trading approach by teaching you the right way? Would it make sense then? Well, we're doing this with my friends from TechMeetsTrader. It's $297 For anybody who wants to move forward, you get 4.5 hours of content that teaches this exact trade. And the guys from TechMeetsTrader put those links on the bottom. You could just click Bond Bootcamp. And I will get into all the questions. I keep adding testimonials, guys, just to show you that this works. Other people are having really great results. Okay. So there you go, 4.5 hours, $297, and my personal email is jonathan@activedaytrader. You are more than welcome to hit me for questions anytime. I'm with you the entire way. Just scroll down to these. Sure. Peter day trades, and he's saying, how would you use these as day trading? So right here is the 10-year butterfly and the bond butterfly. 10-year is going to be here. Bond butterfly is going to be here. Right now, the ZB is expensive relative to the other instruments on the yield curve. If you were looking to trade bonds and you were trading outright, I would only sell ZB and I would only buy ZF right now. Now that doesn't mean that I would blindly just buy them. If I open this up and go ZB, and if I only wanted to trade during the day, you know, whatever strategy you're using to trade, this is the ZB. I would only look for places to sell it. Only sell. Trading ZF, I would only look to buy. It's like I'm a golfer. Jack Nicklaus said that he always wanted to take one side of the golf course out of play. So throughout Jack Nicklaus's career, he always hit the ball left to right. He always played a fade. And he did that because he knew no matter how bad he played, that he wasn't going to miss the ball to the right. I mean, he wasn't going to miss the ball to the left. So he takes one side out of play. Whenever I'm trading, no matter what time frame, I only want to trade things from the strong side. So in this example, I would only sell ZB. If I was looking to buy, I would only buy ZF because the ZF is very inexpensive relative to the rest of the yield curve. So Peter, that's exactly how I would do it. And again, teach you how to do that entire thing. Teach you how to build the butterflies, walk you through the Merck site to be able to show you how to make those charts and butterflies and all that. Andy, can you leverage your opinions on the ES futures trade to leg? Sure. I mean, depending on how you're trading those, what this is going to give you, it's going to tell you the right side to be on. I think people get themselves in a lot of trouble when they're willing to buy and they're willing to sell every product. Okay, so Andy, I'm not sure how you're trading the S&P futures. Can you trade them against the bond? You can. I would strongly encourage you to trade a 5-year against a 10-year. Whenever you're trading something against something else, you're only really doing that because of the relative value of the relationship between the two. So S&Ps and bonds, they do have a relationship, but it changes, right? Sometimes it's an inverse relationship. Sometimes it's a highly correlated relationship. If you're trading just day trading, I'm not sure there's much of a relationship to really exploit there. Yeah, so Peter, I'll do it, but to really understand it, I need to teach you. Hey, Brandon. So what I'm doing is I'm building butterflies. So there you go. So right here is a 10-year butterfly. And so that is the belly is the ZN, and the wings are going to be the 5-year and 10-year. When it gets expensive, you definitively want to sell ZN against anything else. Without a question. If you're selling ZB here, you're at a tremendous disadvantage. Okay? And you can see as it comes off, that's the 10-year coming off in the relationship against the other two. You just want to make sure by being in the right contract that you're getting return on your capital. If you're in the wrong contract, you might be right that the price goes down and the yield goes up, but the 10-year you might make, or the ZB in this example, you might make 5 ticks, but if you're in the 10-year, you might make 25 ticks because you're in the right contract. Okay, so this is just the 10-year. I teach you how to do this with the 5-year and how to do this with the bond and how to do this with the 2-year. Again, it's a cool trade, but it does have to be learned. So when I worked at the prop bond firm, the only way to learn this trade, guys, was we would hire kids out of school. They would have to work nights for a year. They would get there at 7 at night and leave at 5 in the morning. And they would have to put in 1 year before they were able to have a day job and use this trade. Now, because of computers, you guys can learn a trade like this from someone who's been in the trenches. It's a really unique situation in front of you to be able to learn this trade. I don't know who's got this, who was on the TechMeetsTrader original. Here, let me pull that up. So Warren and his team put something out today or yesterday about this bond trade, right? Trading bond futures using the yield curve. And you can see, just go and read through the comments. And all the comments are guys that have, traded with me. David, the first 2 months of this year have been phenomenal. I would tell you my return on my account, but you wouldn't believe me. Dude, awesome. Look at you, Warren. Thanks, buddy. Well, that's awesome. Warren's been a member for 6 or 7 months now. That's how I met Warren. And Warren owns TechMeetsTrader. So you can see these are real results, guys. So what I also do for those who want to take the trade further is I have an advanced bond room. Rafi, nice. So I have this, it's 4.5 hours of content. I have an advanced bond room after this for anybody who wants to take the trade further. In the advanced bond room, there is absolutely nothing that's covered that's not in the bond bootcamp. It's the same exact content. The only difference is a mastermind Facebook group. And all the advanced students are in that room talking trade all day. So you can learn the trade through Bond Bootcamp. If you're interested after that, if you really want to take it further, there's an advanced bonds. The advanced bonds has like 8 or 9 hours of archived class material. And then there's a mastermind Facebook room for everyone who's trading it. There's a one-time fee. It's not a monthly fee at all. So that's the only difference. And then also throw this out, guys. There is, if you hate it, if it's not what I advertised, if you think it's total BS, there's a 30-day money-back guarantee. If you're not happy, I'm not happy. It just doesn't work. Okay? So that's on there as well. So do you guys have any more questions while I'm here? I just want to make sure I didn't miss anything. Ravi, I got lucky. I was just in the right market. So it's cool. I mean, what you start to learn. So if I look here, this just breaks up every spread. And this is going to look, way complicated right now. But all this is doing is it gives me my butterflies up here. And then I'm looking at, this is 2s, 5s, 5s, 10s, 10s, 30s. This is my favorite trade. This is the 30-year against the Ultra. For those who are just considering this, guys, paper trade this. ZB against UB. It's a 1-to-1 relationship. Right now at negative 829, you can sell one and buy the other one. And watch it in the next couple of days. Okay? ZB, UB. Selling one and buying. So you're selling a ZB and buying a UB. It's a great one to paper trade. I'll let you follow along, and then you can see how these trades really work. So Warren, the key to this trade is to play defense. So if you're in the ZB-UB, this trade right here, what we teach you is if it goes against you, you don't want to cut your losers. You want to protect yourself quicker. And you protect yourself by doing other trades on the yield curve. So you're not really just saying like, uncle, I give up. But you might be quicker to protect yourself, which means this trade right here is selling ZB and buying UB. So you're selling the 30-year and buying the Ultra. If you want to hedge this trade, you could buy the 10-year and sell the ZB, and that's going to give you a butterfly. So that's what we're looking to do. If you think about, it's like an options trade. I'll be, kind of go back to options. In order to protect yourself in options, there are many, many different ways that you can hedge, right? So the first thing I'm going to do is I don't want to give up my optionality. I don't want to give up my options position. What I want to do is I want to make a trade that I can kind of stop the bleeding and extend time in the trade. So yeah, Warren, it's a great question. But that's, as you go through and learn, that's what we're looking to do. And as you get better, you're quicker at realizing that, hey, this has the potential to go against me. I should protect myself sooner rather than later. Or some people just protect themselves from the start. For those who think spread trading is boring, that they only want to trade outright, that's not true. That's in your head. I promise you. Spread trading is not boring. Spread trading can be nuts. I know a lot of people think like, oh, no, the spreads don't move around. They move more than you can handle. I promise you. Okay, it's just a sophisticated way of looking at it, but hopefully if you take a step back, there's a common sense element to it. Why guess whether the 10-year goes up or down? Wouldn't you rather guess a relative value against something else? It just makes more sense. Back to the diamonds example, if 2-carat diamonds are more expensive than 3-carat, probably not a bad play to sell some of those 2s and buy the 3s. Okay? So there you go, guys. If anybody's interested, the button's up there. You guys can also email me directly at Jonathan@ActiveDayTrader. I'm happy to answer any questions. And Warren and the team, guys, thank you for hosting me. I really appreciate it. This was a lot of fun. That's what I got. Cool. You guys learned something? All right. Well, guys, thank you everybody for coming out. Yeah, my pleasure. Thank you, guys. All right. Have a great day.